Poppy teaches and advises on agricultural business and policy issues affecting family-scale farmers and ranchers, related associations, and community efforts to support equitable and resilient food and farming systems. She worked 8 years at the USDA, most recently as a national program leader for small farms and beginning farmers and ranchers. Previously, she was a California CPA with an emphasis in agricultural enterprises and nonprofits. She holds a Juris Doctor from Drake University Law School, a Master's in Journalism from Georgetown, and a BS in Agricultural Economics from the University of California at Davis. So Poppy is in the camp of people who, she's new to the ASCMG. This is her first time working with us. And I'm so excited to have her. I hope this is the start of a long collaboration. I first heard Poppy speak when I was doing the Farming and Garden program at UC Santa Cruz. And she blew my mind as someone who came in and really helped me to focus on the business side of my business and how to think about business planning and financial goal setting and all of that long term. So this talk will be about structuring your wealth to build and preserve, structuring your farm to build and preserve wealth. So I'm super excited to introduce Poppy.
Thank you, good morning. Thank you so much for having me. I'm super excited to be here. And looking across this room completely validates why I was so excited to be here. When I worked at the USDA, I worked on beginning farmers and ranchers. I spent a lot of time looking at the USDA data on farming, who's farming, the changing demographics of farming, and you are the changing demographics of farming, and that's just awesome to see. So thanks for having me. This is a big presentation to cover. I already lost my clicker. Is it this thing?
Yes, that's it. Right and left, right and left.
Got it. So, as Lenny mentioned, this is a 1 to 2 day presentation. We've got an hour. So, I just want to, my only goal for you is to introduce a framework, a different way maybe for you to think about how you think about your business. And so I just have some simple goals for this. Don't expect that you're going to take this whole hour in and suddenly rise up and be able to do all these things for yourself immediately. It's really about giving you launching you a little bit down the path. I do find that beginning farmers are very focused on short-term profitability. And the reality is if you don't start focusing on long-term wealth creation, you won't get there until you focus on it. And in terms of the more mature farmers, people who have been farming for a while, there are real threats to that wealth that you've built up over the years. So that's why I talk about building and preserving that wealth. And there's definitely some traps that come up in a more mature business that sometimes people take the bait and they do things that jeopardize their hard-earned wealth. So I just want to give you that framework, and hopefully launching forward from this, you'll be able to find the right advisors and maybe the right motivation in yourself to think more about managing for long-term wealth and for preserving that long-term wealth. So the skill here is really to move you to a balance sheet mentality. How many people here look at their balance sheet? That's good, but you can also see it's not the majority. Right? But that's great. To those of you who do, that's great. You're well on your way. The application of the skills we'll talk about today is the choice of entity. So I'm going to talk for a second about what we got from the survey, but the choice of entity is for sure a decision for people in their early years of farming, but it's not uncommon for people in their more mature years of farming to realize that they don't have the right entity structure. The relationship between business and land is one of the key things I always want to talk about, and again, startup doesn't have that relationship hammered out because they're brand new, but not at all uncommon for mature businesses to not quite have that structured correctly either. I'm going to talk about aspiring farmers and retiring farmers. We have both here, and there's great things to learn from each other. And the thing that really ties it together is taxes. So we're going to talk about taxes throughout. I know there's a lot of people here, or a few people at least from Canada. So the tax structure is different, but it's not totally different, so a lot of the concepts will apply.
Will your presentation be available electronically?
Yes?
Yes.
Yes. Yes. Good note. And so also, please, I'm going to try really hard to keep the right pace on this, but I want to leave time for questions at the end. So clarifying questions like that are great. Questions, if I say something that really triggers a big aha and you have a specific question about application, that's awesome. But I'd like to hold that for the end, just so I can move through all the material, and then we'll try to get to as many questions as possible at the end. So I just want to thank everyone who filled out the survey. It was really helpful for me to have a little bit more of a sense of who I was talking to, because this is a little bit of jumping out of an airplane presentation, because it's not what I normally do in 1 hour. But you can see here that there's a really great spread of experience here, and that's great. So this is an opportunity for sure to talk about some of the intersections between aspiring farmers and retiring farmers. So there's something here for both of you. Oops. Oh, yeah, okay, now I get the hair trigger part. The other important thing we're going to talk about, this idea of structuring your business, has a lot to do with the differentiation between the land you own and the business you own, and not seeing those things as the same. And I know a lot of times people come to their lives and their work, and certainly to farming, with a very profound sense of wanting all of that to really come together in a meaningful way. And that's great, and that's beautiful. But from a legal and accounting perspective, it works better if you're able to make a clear distinction between the land and the activities. The activities are in motion, right, and the land is the asset. And of course the land is in motion, and you do lots of things on the land, but it's a key point that really unlocks the door to building and preserving wealth. So renting, moving in, combining renting and ownership, we'll talk about that. The connection between separating the land and separating the business is the rent payment, right? So you have the business pay rent to the landowner, even though it's the same. That's how that works. And then we'll talk a little bit about infrastructure, which I know is a big issue for everybody. So the topics, we're going to start out with some of the core tests of what makes a business. For some of you who own the land where you farm, some of you who may be in your second career, this might be a very important thing to keep your eye on for tax purposes. What are the real tests of someone being in business for the sake of being in business, not this idea of the hobby, which can be very dangerous. We'll look at the balance sheet and income statement for those of you that are unfamiliar with balance sheet and income statement. And then we'll talk about this idea of how you structure the business. When I say for liability, the flip side of that is to preserve and protect the wealth you've built. How to structure things for taxes, slightly different question. That's a little bit more of a cash flow question. We're going to talk about mixed use property, which will be the 70-some% of you who are farming on land where you also live. And we'll talk for sure about aspiring and retiring farmers and how that works together. So, what makes a farm or ranch a business? It's intent. You don't have to be successful at it, but you do have to genuinely, that has to be your intent. And we're going to move into a little bit what the tax implications are, but the idea is that there are plenty of people out there who are not you, who wish to live like you, but their financial situation is not the same, and their intention is not to make money from farming. And they know the tax code, and they're incentivized to sort of pretend to be farming for profit. So the reason these tests are out there are not to stop you from taking chances and not to stop you from having losses on your farm. It's to stop other people from pretending to be you and taking those advantages that aren't really correct for them. So the basic idea of being a business, it's not that hard to meet the standard. It really isn't. It means running your business like a business, and you're not going to be successful if you don't anyway, so it's not that high a barrier. The key thing, and I think most of you are already over this hump, is you need some sort of a basic theory of how you're going to make money. And so when people present with a very vague plan, I'm going to grow things and sell them. It's really hard for anyone to believe that that's going to make money. But most of you are already so specialized that you've already articulated some sort of a theory. the type of thing you're going to grow and the type of market you're going to sell it into. Most of you have probably already identified that. So you've pretty much met a lot of the standard. Yes, a bookkeeping system of some sort is required for a standard business operation. We'll talk about what some of your options are in that, how deep into that you really need to go depending on your scale. The key things that I would just want you to do to be successful are to regularly review the profit and loss and regularly review the balance sheet so that you have a feedback loop. And that is one of the other tests for being in business is, did you change? It was okay that you made mistakes. It was okay that you weren't successful out of the gate and you had losses. No issue with that. The question is, did you do anything differently based on what you learned from that? Did you modify your behavior in any way? If you modified your behavior in a way that was, most people would have said, probably not going to be successful, that's still okay. So just what does it mean to have a standard bookkeeping system? I think most of your operations are really sufficiently diverse and complex that you're not going to be able to get away with a system as simple as a check register or an Excel spreadsheet, at least not for very long at all. Some people who are very conventional Midwestern commodity producers where there's really 1 or 2 crops and they're really harvested one time a year, planted one time a year, they don't necessarily need a more complicated accounting system, but most all of you have multiple harvests, multiple plantings, right, multiple different markets, so you're not really going to get anywhere with a check register. I would say that that's not really going to fly. Don't panic if you're there, right? If you're in your first couple of years and you're just at a check register, that's fine. But I'm saying make it a pretty short-term goal to up your game on your accounting system if that's where you're at. So the basic system that's used in all normal businesses is called a double entry accounting system, and that means for everything you record, so the check register, you record the money going out of the bank, right? That's one entry. The double entry accounting system, and for most people this will be QuickBooks, which is only a couple $100. The double entry side is you record the money going out of the bank, say you bought seeds with it. The other side of that entry is you show seed expense. So it's not that much more complicated. It's a system, though, the key is, the other part of the double entry, is that it gives you both a balance sheet and an income statement. And that's what I'm trying to drive you towards. Most people stay super focused on that income statement, which is sort of a check register mentality. And they're just watching that cash balance. And that's not the way to be smart about it. That's not the way to really build a business. I think I skipped ahead here.
So tricky.
It is really tricky. I'm trying really hard here. Okay. So the balance sheet, and a few of you said you do, so some of you said you look at your balance sheet. So how many of you look at your balance sheet every month? Awesome. That's great. How many of you look at it every quarter? Also awesome. All completely appropriate, monthly, quarterly, that's right there. So the rest of you who said you look at your balance sheet, you probably look at it once a year. Is that, which is also great. And probably more common of a mature business owner, and probably, you know, those of you that are more mature in your businesses and looking at your balance sheet once a year, probably the reality is you have those numbers in your head at all times. And you don't need to look at it because you kind of know what's there. It doesn't, the point of the balance sheet is it doesn't change that rapidly like the income statement. The basic formula is assets minus liabilities. So the assets are the things you own that have long-term value, and the liabilities are the things you owe. The difference between the two is your equity. That's your real wealth. And that is measured over the life of the business. The income statement is measured quickly over time, right? And it ends every year. So this is just, it's helpful for managing your business to keep an eye on these things in the short term. Most people turn to a balance sheet to look at their accounts receivable and their accounts payable. right? That's the simple stuff that most people enter through. But what I'm trying to move you more towards is the longer term picture, beyond accounts receivable and accounts payable. What have you really built up over time? And that's going to be things like the greenhouses and the hoop houses, right? Paying down the land debt. So liability is also a legal term. You think of liability as maybe accounts payable, short-term payables, but a liability can also be personally incurred, or it can be incurred through an employee, or any number of situations that might go wrong on your farm. That might come back to you as a legal liability that was not about owing money at the feed store, right? Some sort of accident happened, someone got hurt, and now there's a judgment against you. This is where we're going to move into talking about structuring the business as separate from the land, so that anything that goes wrong on that business isn't going to ultimately jeopardize the equity that you've built up in owning the land. So liquidity, and this is going to relate to, I know there's some farmers here that have been farming for a while, so if you're starting to think about retirement, this is at the heart of what you're going to be thinking about. And for beginning farmers, liquidity is really going to be at the heart of how you are able to scale up. So liquidity is the relationship between the assets and the liabilities. If you come into farming with a lot of cash, then liquidity will not be your problem. Right? You can always use that cash to pay debts as they come due. But if you only come in with a limited amount of cash, then what you need to be looking at is the timing, right, between the money coming in and the money going out. And it doesn't happen at the same time. Right? The money goes out, and then there's a pause, and then maybe it comes in. That's liquidity. The other side of liquidity is the classic farmer retirement scenario. You worked your whole life, you've paid off the land, you've built up a nice business. There's still absolutely no money, but it's worth a lot, right? And now the farmer wants to retire. And it pencils on paper. If you sold it all, there'd be plenty of money to go to Hawaii, but it doesn't pencil if you stop working and stay on that land. There's no money coming in. That's a liquidity problem. So that's, again, something for the beginning farmers to think about. If you start planning today for some sort of a farm structure where at some point a second income could come off that farm without you working, you're planning for your retirement in a farmer way. You're planning for that liquidity from day one. For those of you that are thinking about retiring, you're probably already thinking about this question: how do I continue to get money out of this land without having to sell it? And we'll talk about some ideas for that. There are ways to do it, but really it has to do with connecting with that aspiring farmer and figuring out jointly how much cash you can get into the system. So this is the same thing, liquidity and wealth, they're just not the same thing, and that's the classic problem in farming. Farming is pretty good at building wealth, particularly if you do have a toehold into purchasing land. But it's not great at generating cash income. So this is the income statement, and this is the problem, right? It's not great at generating cash income, but people tend to focus on that income side because it's the much more current problem, right? You can always put off retirement another day, but you can't put off paying those bills another day. So people keep themselves focused here on the income statement. Operating income minus operating expense is the gross profit or loss from operations. The other expenses are often going to be the things that affect the balance sheet. Buying a new greenhouse, buying hoop houses, putting in a better irrigation system. Most of those things are labor saving. They do help build long-term wealth, but they eat up cash that you may need to keep your current bills paid and stay in that current cycle. And that's what spins us over into financing, and we'll talk about financing in a minute. The idea here is to have this concept of the current income and current expense. That's your operating situation. You may need operating credit. And then these other expenses, which are midterm and long-term, those may need to be financed separately, and you may want to think about financing them so that you're not financing a long-term investment with your immediate short-term cash you need to keep your bills paid. And people do that a lot. They use their current operating cash to buy something fairly long-term like a greenhouse, and then they need to use their credit cards to pay their current debts. That is not the way to build wealth. So, so same question, what are you managing for? Are you managing for operating profit? Are you managing for annual income? You do need to manage for those things, I'm not saying you don't. You need to manage for cash flow. One of the ways to manage around cash flow is to think about a business plan that smooths income over more months. So some of you may be in colder climates, right? We're up here a little farther north, so it's harder to be in a year-round operation. But certainly one of the things that moves people into greenhouses and into year-round operations is this desire to smooth that income and not have such steep stairs on cash flow. So with that in mind, how do you structure your business to be a good manager and build that long-term wealth? The key thing is keeping people, land, and activities separate in your mind, and this is particularly true when you're farming with other people. So that wasn't one of the questions we asked, but I have a question for the people that are here that are in years 1 through 4 of farming. How many of you are farming just you, not even you and a spouse, just you? Quite a few. Okay, so then I need a different show of hands. So the people that are in year 1 through 4, how many of you are farming with another person? So it's about a split, okay? So, when you go into this structure, even if it's you yourself, it doesn't, you can still, as a one-person shop, structure your business, the activities, as a separate legal entity. Your personal self, you own the land. You don't have the people problem. That's the only thing that changes in this triangle. But you do still want to keep the land and activities separate. That's not necessarily going to be true in your first few years. It may not be economical in your first few years to go through the trouble and expense of incorporating your business separately. You may really want to find out that it works for you, that you're going to be in business. You just want to scale some other things up first. Flower growing is not the kind of activity that is so high in risk that you're very likely to do something in those early years that would really jeopardize everything else. But that is a consideration. Certainly if you are married and your spouse has the potential to be a high wage earner, if they hold a professional license of some sort, if they maybe have some family money of some sort, you do need to understand that your personal business could ultimately carry a liability all the way through to your spouse's other assets. So if that's the case, incorporation is cheap, right? That's worth separating the entities and filing outside the tax return. But if it really is just you and there isn't other wealth and other things to worry about, I'm not suggesting that you run streaming from here and go incorporate immediately. You can give that a little time, but put it on your list of things you want to get to, certainly as you become profitable. So a general partnership, for those of you that are farming with other people, this is the idea of the unlimited liability flows through a general partnership. That's true in a marriage too, right? Similar. It's unlimited liability flowing through. The way to get out of that is to form the corporation.
I can also do it for you from here.
Yeah, because I can't quite see when I'm,
Forward or back?
I think I'm going to switch over. I'm good now, but I think now I'm just going to let you switch because it's distracting to me.
Totally.
So the cost of incorporation, in addition to the incorporation fees, in some states there's a minimum cost to just passing go every year as a corporation. So whatever state you're incorporated in, you do want to be sure to have that as a consideration. In California, there's a fairly steep minimum franchise tax just for getting that liability protection. So S corporation or limited liability company, people usually hear form an LLC. My theory is that people tend to say LLC instead of S corporation because LLC sounds easier to understand on the surface. A limited liability company is simply a very simplified form of corporation that allows you to have some of the simplified accounting of a partnership with the legal protections of a corporation. An S corporation is a tax creature. It, from a sort of legal liability sense, it gives you that same limited liability protection of a corporation without a lot of the rigmarole of a large corporation. But mostly it gives you very specific tax advantages. A little complex to explain. I'm going to walk you through a slide in a minute. But the point I'm trying to make here is if you're sort of chatting at the coffee shop with friends and getting advice from friends and they're saying LLC, LLC, you all be a little smarter now and think, I'm going to check into that S corporation as well. Because if you're profitable, for a tax perspective, an S corporation is likely going to be a better structure for you. Right? So this is a simple walkthrough of how taxes look under these different structures. So if you're a partnership or a corporation, either an S corporation or an LLC, the entity, the separate business entity, files a tax return different from your tax return. It passes net taxable income through to you on what's called K-1. That's going to be functionally very similar to a W-2 that you get from a regular job. And then you yourself, just like you always have, are going to file a 1040 for yourself as the individual. These are called pass-through entities. The tax income and the tax liability passes through the entity back to the owner. So you could just think of it as annoying full employment for accountant tricks. In some ways it is. But it's also the way we structure things so that we get that legal protection, right? This whole mechanism is the same mechanism that prevents that possible legal liability from passing through the business and getting your personal assets. So yes, a little annoying and maybe seem like busy work, but you have to, if you think of it as protection, as the price of the insurance, and in some cases the price of actually saving money on your taxes, that may motivate you a little bit more. So the actual cash that pays out to the owners in this scenario is not necessarily the same as what you get taxed on. So for those of you that are early in business and moving into this scenario, that's one of the places where people get in trouble in the first few years, is they think that the cash that they took out of business is about what they're going to be paying taxes on. And there's a number of reasons why that really might not be the case. So particularly in your first years using an entity structure like this, you really want to get in and see your tax preparer in the fall, no later than Thanksgiving, and do some projections so that you have a good idea of what your tax bill is going to be and you can hold back that cash. So a note on partnerships, there weren't so many of you that were maybe going into partnerships with other people, but something to be aware of. I work with a lot of beginning farmers who are really, almost overly anxious to make a deal work, particularly if they find a piece of land that they've fallen in love with. And, a lot of times there'll be some disparity of wealth and ability going in, so it kind of makes sense. One person has more resources, one person has more time to work, and they figure, we think this sounds fair to us, and we're going to go forward with this agreement. But for tax and legal purposes, if you say you're 50-50, you have to actually be 50-50. You can't be on your way to 50-50 in your mind. That won't give you the right structure. So if you're getting into any sort of a partnership where it is truly anything less than you put equal amounts of dollars into the checking account and truly go in mathematically verifiable 50-50 or whatever your percentage is, it doesn't have to be 50-50, right? 75-25, whatever. But the dollars have to match that. And if it's not the dollars, it has to be the fair market value of whatever equipment gets put in, right? So someone puts in a tractor valued at $5,000 and someone puts in $5,000, that's fine. But if someone puts in 5,000 and someone says, well, I'm just gonna do the extra work to work off that 5,000, that's where you really do need to see a professional and make sure that the way you're structuring that is actually gonna get you where you wanna go and not gonna surprise you when you realize it didn't get you where you wanna go. This is just the old-fashioned corporation. Remember, we're talking about S corporations. This is the C corporation. That's the kind that's for sale on Wall Street. That's not you. So I only have this up here so you know that that's not you, okay? The C corporation, for tax purposes, it is the least advantageous way to do business. So there's really no scenario where a small business person chooses a C corporation. There's some that are remnants from before S corporations existed, and sometimes people didn't update their business plan. That's really the only time you see them. Okay. So this is the S corporation again, and the very simple structure. And again, I'm not expecting you to leave here knowing how to do this. But the difference with an S corporation is that the owner actually takes a proper salary. You actually get a payroll service. You take a salary with salary deductions. So from your side as the owner's side, that's nice. You kind of don't have to worry about that. It happens through the corporation. And then the corporation can deduct those payroll costs out of the net profit of the corporation. And you, in addition to the salary that you get from the corporation, you get that little remnant, whatever the net income or loss of the corporation is. So if there's 3 or 4 of you get your salaries out according to how much you work, and that may vary. You may have an agreement that not everybody works full time, your salaries fluctuate, that's all fair and good. But then if you're all equal owners, after you deduct salary, after you deduct the payroll taxes on the salary, whatever benefits plan you have, then whatever that net that's left over, that is what gets divided according to your ownership of shares, and that comes out to you as a little bit of additional income. The other thing the corporation is doing, if there's a land situation, is it's paying rent to the landowner. One of the reasons that I'm encouraging this kind of structuring and talking about multiple business owners is it's also often the case if you have one person who's really in a position with a lot more wealth, that one person may become the landowner. But if you separate the land, then you can have a more equal ownership of the actual business. Right? And allow the person that's in the position to do the heavy lift of getting that land to kind of keep it simple. They own the land. And then the 3 or 4 people come together to work the land in a business. Otherwise, what ends up happening is people spend all day sitting around the kitchen table scratching their heads trying to figure out how to equalize this wealth disparity while they're all simultaneously buying into the land of the business. And the reality is sometimes they never get there because that's just too big a wealth gap. Certainly to bridge in a short period of time. Maybe it could be bridged over more like 10 to 20 years than 3 to 5 years. I did notice from the survey that some of you were here as employees of nonprofits. This is a whole other class, so I'm not going to get into it other than to just put this up because it always comes up. A nonprofit is an entirely different kind of entity. There is no such thing as owning a nonprofit. So if you work for a nonprofit, you're an employee, and the big danger sign here is there is often temptation. People always have ideas about how they're going to start a nonprofit, essentially to fund and finance the lifestyle that they want. And that's tricky territory. So that's all I'll say on that. But it's another one of those things out there that be careful what you hear from your peers on the subject of nonprofits and farming. And that's a whole other seminar for another day. So this is about the mixed-use property. So this is the scenario that lots of people aspire to. It's the home place on the farm. So the key document to have, and if some of you have fairly newly purchased a property, does anyone here have a recent farm appraisal on a property that they've purchased? Great. To clarify now, so there's an appraisal. Anybody who bought property recently probably has an appraisal. But are you sure that the farm appraisal you have is done by a certified farm appraiser? Oh, okay, awesome. 1 yes, 1 no. That's totally what I would expect. Super, super common. Particularly with a property that It may be in an area that used to be heavily agricultural, but now it's in an area that's sort of suburbanizing. And so you're losing the knowledge infrastructure and the habits of people that are attuned to agriculture. And so it's something that maybe even 15 years ago, certainly 20 years ago, it would have been standard to do an ag appraisal. It would have been standard for the accountant or the real estate agent to tell you to do the ag appraisal. Now they're sort of all thinking about something different, and they don't mention the ag appraisal. But a certified ag appraiser is qualified to value those agricultural assets. And I'm going to walk you through why that's important. One of the things that will be valued, the different soils will be valued differently. Any farm assets that are there will be actually seen and recognized as farm assets, not as that pile of wood over there used to be a barn, but it will actually be a barn. Go to the next slide. And the key thing for any of you that may have trees, I realize this is cut flowers, but on these properties, the big thing that gets missed is if there are fruit or nut bearing trees, those are farm assets that are valuable. They're valuable for tax deductions and very commonly missed. So I don't expect you to be able to read all this, but you'll be able to read it when you get the copy of the presentation. But the step one is to go through the appraisal and to identify the personal and the business assets. Just spread them out. These are in the business column, these are in the personal column. I'm trying to do sign language here, so we're like, cool. The second step, and this is what's really critical, is to calculate the ratio of the business to the personal assets. Because you're going to use this ratio pretty much for the rest of the life of the business.
If you haven't recently bought your property, you've had it for a while, is there a benefit to getting agricultural appraisal? Okay.
Yeah. You can amend your tax returns.
Repeat the question too.
Yes, thank you. The question is, what if I didn't do this? Can I go back and do it? Yes, at any time. You can amend your tax returns going back 3 years. So if you're still within 3 years of the beginning, you can go back and recapture all of the value that was potentially lost. If you're 6 years in, you can only go back 3 years. So sadly, if you're 6 years in and you didn't get this right, you've lost 3 years of deductions. Don't feel too bad, it happens all the time. But you can go back 3 years and fix it. Okay. So step 3 is setting up the business assets for tax depreciation. So that's where you go off the appraisal, you pull the ones that you put in the business use column. They're now not personal, right? They're business. And that means you can take a tax deduction for them. So if you have a barn on the property, even though you're not particularly using it, but you're using it somewhat in your business, if that's a 20-year barn and it was given a $20,000 value, you get to recuperate that full $20,000 of purchase price over the 20 years. That's not a ton of money in any 1 year, but it all adds up, it all helps, right? And this is we're playing a long game here, right? And every time you take that current tax deduction, that gives you a little bit more current cash. It helps your current operating situation. So you have to look at these tax deductions a little bit as how you finance your current operations. And you do have to understand that that is the intention, right? This is intended to work this way to help small businesses start up and get going and hopefully become successful and become taxpayers in the future. So never feel bad about taking the deductions that are allowed to you. Yes?
What happens if you inherit the property?
Great question. The same exact thing. So what you inherit when you inherit property is you inherit the land and the assets on it, and you inherit you do not, you're not Canada, right? You're here.
Yes.
Okay, good. Because I don't know Canadian estate law. You get what's called a step up in basis. So if you're given a property, you are given the property and the donor's basis. So if Dad gives you the property and goes to Hawaii, and Dad bought the property in 1970, you get the basis. These numbers are his 1970 numbers, not that helpful, right? But when the property passes upon someone passing, you get a step up in basis, and you do the appraisal on the day of their death, or as of, not on, but you tell the appraiser. You tell the appraiser the day of, right? And for estate tax purposes, you have a choice. You can do day of or 6 months after. So very commonly, they'll do both numbers, and then they'll choose whichever number is advantageous to you. So then you take that appraisal, and it's exactly as if you had purchased the land on that day. And even though you're not out any cash, you can start depreciating those assets anew. So that is another way that it helps you when you inherit a new farm and you got to get going now as a new business. These tax deductions that you might feel are kind of free, right? They can be super helpful in infusing some cash back into the business when very likely it really needs it.
So every generation can re-depreciate,
That's exactly
even though
right.
it's been depreciated several times.
Yes, that's exactly right. And if you think about why that is, don't think about it in terms of, that feels like double dipping. Think about it in terms of the reality of you're often very cash short after someone passes. And so this is a way for the government to actually get cash back in your pocket pretty quickly. So hopefully that business continues and doesn't tank at that point. Someone else had a question?
Is that specifically for someone that stays in the family?
It's for inheritance. So if someone chooses a non-linear heir as an heir, it's the same. There's no preference for there. We are actually going to talk about the situations in estate law where there is a specific preference for things that pass within the family. But this question here would apply equally to if the property is passed to, say, a long-term employee who is helping with end-of-life stuff, and that's part of their reward. That's the same difference. Okay, so the final step here, and we're going to talk about estate stuff more in a minute. You take that ratio between business and personal, whatever that ratio turns out to be, and you use it sort of forevermore to apply to mortgage interest, property taxes, property insurance, repairs and maintenance for a shared road, all those sort of shared land costs. So again, if you're not doing this, if you haven't already set this up, you've maybe been taking 100% of your mortgage interest as just a mortgage interest deduction on your personal return. Well, that's nice, but it was worth way more to you on your self-employment tax return where it could have offset other earned income. So even though having a new appraisal done will easily cost you a couple $1,000s, and going back and amending your tax returns will cost you several $100s minimum, it still will probably set you up in the long run to be in a better situation. Go ahead. We're going to talk about some of this estate stuff, and I just want to kind of prep you for this. This is like the last hard, difficult conceptual dive here. So for aspiring farmers, be thinking about this and thinking about how you can see yourself in this equation. And for retiring farmers, this may help you with some planning of how to make things work for you, especially if you're thinking about estate planning. And if I lose you on this part, don't worry about it. You'll have the slides, and this isn't the kind of stuff you hear once and do once anyway. This is the kind of stuff you have a few conversations and you get lots of different advice about it before you dive in. So what are the typical challenges that some sort of an estate or retirement transition plan needs to address? Liquidity, that's why I started out talking about liquidity. That's going to be the main hurdle. The structure, we've talked about the structure. Sometimes the barrier to the estate plan is that the business isn't structured correctly in the first place, so you can't see it clearly, so you can't have a clear conversation with the other person because you're kind of sitting on something that's a little too mixed up to talk about clearly. So structure is the other challenge. So sometimes to get moving on an estate plan, the first thing you have to do is kind of back up and restructure your business, and then you can move forward again. And then the estate valuation, we're going to talk about this in a minute. This is the new concept I'm introducing here, how you value these things at the time of transition. In a family situation, the classic challenge, particularly for farm families, is the difference between actual equity and perceived equity. If there's more than one child, one wants to stay and farm, 2 have gone to town and are not coming back. 1 may be doing fine financially, 1 may be really struggling financially. Parents are often very reluctant to do anything other than same, equal, even though that's not necessarily what really maximizes everyone's overall good. But those are difficult conversations to have, and typically can take years to get through. Often bringing in an outside facilitator, really talk everything through and figure out what the different strategies are for making everyone feel that they have actual equity and perceived equity. Go ahead. So, on the liquidity side, you're looking at income, cash flow for the retiring farmer and the incoming farmer. And that can be within a family or non-linear, right? So within a family, a typical situation is mom and dad aren't making enough for the kids to come home and also make a salary on that same piece of land, but everyone wants that to happen. Actually, it's interesting talking to this group because I talk to more conventional farmers a lot, and the example I often give is maybe that incoming younger generation comes in and they do a specialty flour deal, totally different deal from the current commodity deal that mom and dad are doing. They get to be together, they get to have that experience, but actually the businesses are pretty separate, and that's the only way to create that second income is to go for that higher value income, higher value off of less land, because if it's the same value across all the same acres, you're not going to get there. Go ahead. So we've talked about this, the separating the land from the business, bringing the new farmer into an existing business, or starting a new business on existing land, maybe in a situation where you can have some mentorship and shared assets. And then maybe winding down an existing business. If there's an existing business that's been doing okay, but you can kind of see that the future doesn't indicate that it's going to continue to do well, so maybe it's time to start to wind that business down as a new business is on the rise on that same land. And if you can line that up so you cross over at about the same time, it can be a nice handoff. So very quickly here, the estate tax is currently set at $5.5 million. That's a lot of cash to have in the bank, but that's not a whole lot of real estate to have in a lot of places, right? Lots and lots of places near prosperous cities, land values are just really high. So even though people don't feel particularly wealthy, if you cash that land out, you'd be hitting that mark. So the key is to reduce the value of the total estate through special valuations. So the first step of that is that if the business is separate from the land, then you value the business. And if the business has already been divided up across the different heirs, and if the business owner, mom and dad, have already passed some of that ownership to the kids, then when mom and dad pass, they're not holding the whole business. So the whole business doesn't get included in the estate. So that's sort of the basic trick on the business side. The second piece is on the land, and this is the one piece where it matters if it's actual lineal descendants, or if not lineal, familial. So if the land has been, and this is the one that's going to lead us up to the key example of how to do this, even if the estate tax doesn't apply, this is the way to structure a handoff. If you want to keep the land in farming and ranching prior to the senior generation that's there passing, because that's what they want, right? They want to work and have a satisfying life. But they don't want all the work. They don't want all the responsibility. They are trying to wind down. So there's room for an incoming farmer to come into that situation. If that land stays farmed in farming, ranching, or timber, it's 5 out of 8 years prior to the passing of the senior generation, then if it's going to pass to family members, you're allowed a special valuation. And that valuation is at the agricultural value, not the speculative luxury ranchette value. So go to the next slide. The difficulty here for most families is in order to maintain that special valuation, which would really reduce the estate tax, the incoming generation, the incoming incoming family members have to continue using that land for farming or ranching or timber for the next 10 years. And that's where they're typically unable to do that. When I used to do estate taxes, I used to spend a ton of time amending estate tax returns 5 or 6 years after the passing of the senior generation. The kids, at the time mom and dad died, they said, we can do it, we're gonna keep farming, we totally are. We don't wanna pay those taxes. And so then for 5 or 6 years, they're like, yes, we're farming, and then after 5 or 6 years, we're not farming. And then that tax return, when we pay the taxes, we are not farming. We cannot even maintain the fiction that we are farming. Yes?
How much of a percentage of the land has to stay in farming? Is it, if it's just some farming is happening, or all the acreage still needs to be?
That's a trick. There are rules on that, but they're sort of flexible, and that's where you would bring a highly qualified farm appraiser, because they have a lot of tricks for classifying wasteland, right? The land that isn't usable, so it doesn't count anyway. There's lots of tricks for how you do that. So you just need to know what to ask for, and they need to understand the purpose of the appraisal, and then they will work with you to get you the best appraisal they can for the purpose that you want it for. And then, worst case scenario is some of it doesn't, right? Some of the land may kick out and not be subject to the special evaluation. But you get as much of it as you can subject to the special evaluation. So go to the next slide, please. Thank you. So the material participation, the part that you're going to have to keep going for the 5 or 10 years, don't read the slide. The point is there's rules, right? There's a few different ways to get there. It's 100 to 500 hours. There's a few different ways to get there. That's the point. But there's rules, and once you're in this situation, you've got to be monitoring them. You've got to follow them. So next slide. There's a little bit of an out for disability or spouse. Next slide. So here's the short version. There's the planning opportunity I'm trying to get you to. You want to keep the land farmed right up to the point that the senior generation passes, and then you need to keep it farmed for 10 years after that. And you've got heirs who are really motivated to avoid estate tax and maybe motivated to actually farm themselves, right? That's the opportunity for the aspiring farmer to come in, is you take on the heavy lift of that, right? You do the actual management part and operation part of the farming. You're farming with dad in those 8 years up to dad's final exit. You're getting all that mentorship, right? Dad has an awesome chance to feel worthwhile and participating in the farming, but at the same time can also take vacations and relax and not take all that burden on. And then after, and it's not your dad, by the way, it's right, someone else's dad. And then in the 10 years that follow, there's dad's kids, right, who are your sort of farming partners, but you're not equal partners. They're satisfying their 100 to 500 hours a year requirement to be substantially and materially involved, but you're mainly the one running the business. And then over that time, you can structure how you ultimately buy out. You may even structure some opportunity to buy the land out from under the business. So none of that's possible if you don't have that clear separation between the people, the land, and the business. If you're always looking at it all being mushed together, you can't get to something as nuanced as this. So this is the example. So the exiting farmer, the heirs goal, keeping the land in the farming, but they don't want to farm full time, and the new farmer coming in, no way are they going to afford to buy the land, but they can buy into the business, at least for now. So they buy into the established farm operation, maybe just a minority share, phase out the old activity, but maintaining the material participation to set up that estate transfer. When that person passes, the heirs step into the shoes of that material participation. The aspiring farmer continues operating the business with the heirs, and then the heirs can eventually pass the land out to Farmer Y if that is financially feasible. Because at that point, Farmer Y may have been there for 20 years, right? And may have acquired enough savings that they could actually buy that land, especially if there's financing available. So, all right, we got 15 minutes, and I do want to circle back to one thing. So at one point when I was having trouble with the slide forward, I skipped a really important slide. So you'll have it, but I just want to stop here and go back before we move to these final slides. The slide that I skipped was about the hobby loss rule. And so I talked around it and set you up for it, but the hobby loss rule is designed, as I said earlier, so people are motivated to masquerade as farmers so that they get losses on their tax returns. They can take a tax loss from their business and use it to decrease their normal taxable income. So that's beneficial. How do you make sure that you don't look like someone who's masquerading like you? Right? The hobby loss rules say that if you, first of all, 5 years from the time you start, you have the presumption of innocence. The presumption is if you say your intention is to make a profit, IRS takes you at your word, they're required to take you at your word. The end of 5 years, if you have not been profitable in 3 of those 5 years, all that happens is you lose that presumption. And now, the first thing you have to do is be able to demonstrate to the IRS that your intention was to make a profit. You do not have to demonstrate that you were successful at making a profit. You have to demonstrate you intended to make a profit. And it's actually even easier than that because it doesn't have to be an actual immediate short-term cash profit. It can also be that you were primarily holding the land for its long-term appreciation, and the farming activity was to offset the costs of maintaining that land and developing that land as you held it to appreciate, which is very much more often the situation in a case where someone's living on the land and farming it. They know they're not really going to get cash profits off that farm business, but they know that if that farm business can absorb all the costs of improving the property and they hang out for 20 years, they're going to come ahead financially. That's fine. That is fine. The tax rules are fine with that. They just give you a higher burden of demonstrating that that was really your intention. So the reason I harp on this, and I'm sounding super serious right now, is because one of the most common misperceptions I hear, and I travel all around the country talking to beginning farmers, one of the most common misperceptions I hear, people tell me that they bought a property, they were going to set it up for farming, they did, but their accountant told them it was just a hobby, so to not bother with all that stuff that Poppy's just been talking about for an hour. Right? So Poppy, why were you just talking to me for a whole hour about this when my accountant told me that it was just a hobby? And I hate to say it, but it's the truth. It happens a lot more to women. And that makes me extra bad. So that's why I'm extra. If anyone ever tells you that's just a hobby, you go ahead and be offended. And you can call me and I'll be offended with you. But it's a very common misperception. You won't find it so much if you go to a qualified CPA, but it's very common if you go to a cheaper tax preparer. And they're just trying to crank you through, and it's also another way of them saying, I just can't be bothered. And so if they don't want your business, take your business somewhere else. Because the way you make money at this deal is by taking every single tax deduction that's available to you and using that tax savings as part of how you finance your business. That's the deal. So if you're not taking the tax deductions, you've set yourself on a much less likely path to success. So sorry I skipped that slide, but that was sort of the framing of why I'd set you up for what does it mean to be in business.
Yeah.
The idea here is that the tax losses themselves are valuable, and they're part of your financing plan. At some point you outgrow them, you become straight up profitable, you pay taxes, that's awesome. But that doesn't happen right out of the gate. So just a couple slides to wrap up and then we'll take questions. For any of you who are wondering how you do your taxes for the first year, California Farm Link on their website, they have a little booklet. It's like a 12-page little booklet that can help you get your documents all organized. And if you fill out that booklet and then you go to a tax preparer, that booklet will kind of steer that tax preparer down the right path. The tax preparer may not know farms, but the booklet has all that language in it. You can also fill out the booklet, and then if you really feel the need, give a shot yourself on TurboTax or some sort of an online program. It'd be very difficult for you to get it correct just sitting down with TurboTax or sitting down with HR Blog Online and doing it cold. But if you fill out the booklet first, and then you go from the booklet to the computer program, you'll probably pick up everything you need to. Because the booklet walks you through all these things I've been talking about. Next slide. Other thing, people say, you know, oh, I'm not doing it yet. I don't have to worry about everything she's talking about just yet because I'm not profitable yet. I'm just experimenting and this and that. Don't talk like that. That's the same thing I was saying before. You're just shortchanging yourself these current deductions. If you took the time to come here, you're pretty much farming enough. And even if you truly are in startup and you really haven't started, you can still hold on to all those startup expenses and wait until you go into business and then deduct them. So don't let them go. Don't just blow it off and say, I'm not really for real yet for another year or so. Hold on to all those expenses, keep track of all of them, and then when you really do go into business, take those deductions. And particularly, if you've acquired the new property, do not wait. If you've acquired the new property, get that farm appraisal done, get that set up as soon as possible. So that's, we still have, what, 5 or so minutes?
On the,
Go ahead.
on the special evaluation, if you are renting land, you create the farm on undeveloped land, you are not an heir, there's no family tie. Does that special evaluation, isn't there something in the tax code that allows a sale versus an inheritance for that land to be valued? If you've been farming it for 5 years, you plan on doing the next 10, does that apply in a true sale versus an inheritance?
Believe it does. I'd have to.
Is it the same code section or is it a different code section?
I'm not sure.
Okay.
I'm not sure.
Okay.
Good question. That's at the level of detail where you do need to be, you know, you need the local professional who knows. That's a good question. I will look at that up after. The question was if the special valuation held if the land was sold to remain in farming. I don't think it does though, because you have to maintain the family member's farming for 10 years after. But there are different special valuations for land remaining in agriculture. And there's also state law that varies state by state. Some states have special rules that incentivize farmland staying in agriculture even without the linear heirs issues. Yes?
You said to hold on to the expenses that offered. How long a time period should we hold on to it from before we?
So
Is it within the year you take or also from the year before?
yeah, no, you can hold on to them for several years. So the year that you truly begin farming is not the year that you first get revenue from selling the flowers. It's the year that you put the seed in the ground or the bulb in the ground that you will sell. So that it could straddle 2 years, right? It could fall plant, spring harvest. So there's no income in this year, but that's really the year you start. So if you had expenses for 5 years prior to that, because you spent 5 years going to seminars like this, taking classes, doing business plans, you save all those receipts. You just save them. In that year 5, which is now year 1, that all those receipts become one asset, startup costs. And then you take 1/5 of those over 5 years, and that's your startup cost deduction over your first 5 years.
This is a bit general and a little bit different, but I think there's probably large group of people in this room who are pretty new to farming, probably don't own land, and are growing flowers, selling them wholesale or whatever, also doing design work, so designing for weddings. So what are a few considerations that people should keep in mind from the beginning, and how should they explain this to their cheap accountants or
All right, thanks for that. No, I'm really glad you asked. like, I mean, it was really hard to figure out what talk to put together
Totally.
for this.
And it might be a minority in the room.
No, it's a super important question. It just didn't fit with the narrative I was trying to create. But that doesn't mean it's not really important. And really hard to answer. Okay, so I'm going to tell you two different things here.
Yeah.
Okay? So technically, the design services are not farm income. Technically, the rule between farm income and non-farm income is pretty strict. And in many situations, you can get in real trouble for pushing yourself across that line and calling non-farm income farm income. And that's because for income tax purposes, farmers and ranchers get very, very favorable treatment for certain things that other kinds of businesses do not get. So if the IRS comes looking, they want to look and see that the farm benefits just stay on the farming side. What they're really worried about is wineries. Right? The rules are all written for wineries. Okay? So if you're a grape grower, you can hang with the farmers. You can get all those wonderful benefits the farmers got. But if you're a winemaker, no one feels sorry for you. They can't wait to tax you. And if you're the same person, there's going to be a lot of auditing of that line. Okay, so that's where the rules come from. And if you followed that very formalistic way of thinking, then you would say the flower design business is the winemaking. It's over here, it's a separate business. And the flower growing is the farming, and it's over here, and it's farming. And you may encounter a CPA who wants to do that. That is not your person. Because that person is being a little too serious about things. Because in this case, there is no difference in how much tax you would pay when you combine the two. Okay? Because it's not winemaking. Because the design service doesn't turn into a $100 bottle of wine that sits around and has all those inventory implications.
Yeah.
Right? The design service is immediate. It flows out of you at the same time the flowers come off the property. It goes, the wedding happens, it's gone. Right? There's no timing difference. So the way I think this through is that if you combine your design services and your flower growing business into one business, you do one accounting, you report on one tax schedule, one net income number that you pay tax on. You have essentially made a grammatical error somewhere in there or misspelled a word. Everyone understood what you meant to say just fine, right? The end result was completely the same with this little meaningless error, which we should all move on. Okay? It's not the same thing as if you truly use the wrong word and you've come to a completely different conclusion, which absolutely would be the case if, so here's the flip side of that. If you are doing lavender soap, essential oils, those kinds of things, that's a whole different class. But that follows winemaking and grape grower. And if that's the case, then you do need to understand where that line gets drawn. And either scale your business up so that you're handling the essential oils and the soap and that stuff like wine, or there are other strategies you can use to make sure your inventory is always zero on December 31st. It's called Christmas sales and Christmas gifts and going on vacation in December. Right? So you make sure that inventory is gone. If the inventory is absolutely gone, zero inventory on December 31st, because anything you had you gave as promotional gifts, right? Then you're back in the same situation. It's technically wrong, but no harm, no foul. You're paying exactly the correct amount of tax, just a slightly wrong way.
Let's take two more quick
Okay,
questions.
I'm counting on you to be the time person.
Totally. Two questions. Yeah.
There's interest in agritourism.
Yes.
Bringing people onto the farm and also doing workshops. Do we treat that any differently, or is that the same as doing what?
Exactly what I just said, right? So technically, it's totally different. Technically, it's a different business. Agritourism, you're a hotelier. Farm seminars, you're a consultant that teaches. You're not a farmer when you're doing those activities. There's So the advantages to farming, you have to know if you're taking advantage of those advantages to farming. So one of them, and there's several different discrete advantages, but one of them is that if more than 70% of your income is from farming, then you get very lax rules on when your estimated tax payments are due. So if you're not taking advantage of that, then it doesn't really matter if you lump all your income together. But if you are someone who was only paying their estimated taxes once a year because you were counting all your income as farming, but actually if you analyzed that, you wouldn't hit that 70% threshold, because actually most of your income is from your agritourism or your seminars. That's an example of how you could actually get yourself in trouble. So if you have a mixed business like that, my advice would be have that open and frank conversation with your tax preparer, make sure that they and you are telling the same story about your business and you're both comfortable with it, and you'll probably be okay. Yes?
What if, like in the case of workshops, or other agritourism activities, that they're actually taking home with them farm products? Would that make any difference? For instance, if you have a workshop and you're teaching them how to arrange flowers, but they're taking all of their work home with them when they're there.
Yeah, I mean, if you needed, so this is the conversation with your one-on-one advisor, right? Like, what are you really after? What's really important here? If you are someone who's kind of on that borderline and you want to make that 70% threshold so that you only pay your estimated taxes once a year, and you're borderline, then you could go through some sort of elaborate thing where you recharacterize your your wreath making workshop as what you had to do to sell the wreath, right? So, there's tricks you can play. That's really what your tax advisor is there for if you have the right relationship. But you don't want to dive on the trick first, right? Understand what you're trying to do first, and if you're not really trying to squeeze into this definition anyway, then you don't really need to go to a lot of elaborate measures to do stuff. Can I take one more?
Quick one.
How do you go about finding a financial advisor that's an expert in that field?
Thank you. I knew I had to take your question because that is my favorite topic in life. Thank you.
Did you plant her?
Okay, as quickly as possible. 1, it's super hard. 2, it depends where you live. 3, if you live where there are wineries, go to where the wineries go. Okay, so if you're fortunate enough to live where there's wine industry and wineries, go to their accountants because those people know ag tax. Everything I'm talking about, if you do winery stuff, you know this stuff cold.
Yeah.
Okay, if none of the above is true, then yeah, it can be really difficult. And so, I'm sorry, what?
Does the USDA have?
Oh God, sorry. There's a reason I don't work at the USDA anymore. And that's because I spent 10 years there trying to get them to take your question seriously. 10 years trying to get them to take the lack of an answer to your question seriously. I was planning on going back there and doing that some more. I wish so much that I had a better answer for you, but all that I can give you and to all of you is this is legitimately hard. This is why I do this. If you don't have a good relationship, that's a real problem. It's a real barrier to your ability to get this right and create long-term wealth. And so the best I can say is keep looking until you do find the right person. And you may have to travel a bit, and that's worth it. On an accounting side, there's nothing stopping you from crossing state lines. I'm not sure there's a whole lot stopping you from crossing country lines. The tax part is different, but the basic accounting theory is the same. For legal purposes, for like your lease and are you violating local water law, those kinds of things, you have to be with an in-state attorney. Attorneys are only licensed by their state. But accountants, really federal tax law, if you have to cross a state line to find someone you can talk to, do it. And I don't know what else to say. And I guess the last piece would be, if this is a problem for more than one person here, can we connect to Judy and maybe identify some CPAs that serve your industry and let them, and like create a network, a referral network?
That'd be great. That'd be great. Webinar.
Future webinar, you think?
Global Farm Bureau's
per people.
Great.
And then, as you know, many accountants have licenses in multiple states.
Yes.
So you can, you find something really good that's not in your state, that you can, in the electronic age,
Great.
you can communicate really well. And if you know what you're doing, it's worth, you know, maybe making one trip and have a face-to-face with that role. They're really organized, too, they can make a world of difference in your life.
Are there any accountants in the room that want to out themselves?
I'm not an accountant, I'm in estate planning, work in estate planning on the financial side. We work with landowners and farmers. So it's a little different mix, but the same thing that you're talking about. And I have some great resources.
Great.
When you guys put that together, I can share some of those.
Definitely.
And no doubt you work with accountants.
Yeah.
So
Yeah.
you would maybe be able to refer some of these people to accountants that you
Sure.
trust. So
Well,
helpful.
You gotta
Thank
be
you.
careful there, but you,
Okay.
yeah. Right?
Yeah.
Let's follow up.
Okay. Thank you all so
Thank
much.
you.